Today we're looking at the bear put spread, which is a type of vertical spread. So this means that there are two legs or two options in this trade. In this case, we are buying a put and we are selling a put. And to be a vertical spread, these two options have to be the same. They also have to have the same expiration date. The only difference between the two options is that their strike prices are different. And in this case, you can see the strike price of your long leg is $40 and the strike price of your short leg is $35. For a bear put spread, it's always going to be the case that the put you buy is the strike price is going to be higher than the put you sold at. Now this is all similar to a bull call spread, and except for, well, in the fact that it's the exact opposite. That's about the dumbest thing I've ever heard come out of my mouth. But just think of this as a bull call spread with a different market outlook. You think that the stock price is going to go down as compared with a bull call spread, you think it's going to go up. This trade requires a debit from your account. And why is this? Well, for the put you bought in this example, you paid $300 for this. This was debited from your account. It was taken from your account. The put you sold, you were credited $100. So if you were debited $300, but your account was credited $100, or $100 was put into your account, then the total difference is going to be negative $200, or the amount you paid to enter the trade. This is debited from your account. Now this is also your max loss, so that is similar to buying just a naked put, in that your losses are capped. However, unlike a naked put, your profits are also capped. Now this may seem like a bad thing because if you just bought a put outright, it potentially has unlimited profit. You give up some of that unlimited profit for a good reason, and this is because the overall probability profit of this whole trade is greater than just buying a put outright. And why is that? Well, this is because the theta decay you experience with your long leg here is being counteracted by the theta decay of your short leg, because when you have theta decay in a put you buy, you're losing money each day. It's getting taken out. But with a put you sell, the person who bought it from you is losing money, and that money is going into your pocket. So some of the theta decay is negated. This increases the probability of profit. One reason people might trade this is because it requires less capital. It's a lot cheaper. In this case, it's $100 cheaper than just buying this put outright. Now, if the underlying stock price goes down, you will earn premium just like you bought a naked put. It'll be a little less premium, but you'll still earn premium in a similar fashion. Now, I just want to go over some calculations here with you. Your max profit is $300 up here is going to be equal to the strike price of your long put minus strike price of your short put minus net premium that you paid. Pardon my shorthand. So in this case, the strike price of your long put is $40, the strike price of your short put is $35, and the net premium that you paid, it says 200, but when you're looking at options premium, it's written as this divided by 100, so it's 2.00. And in this case, this equals 3.00, and you have to multiply it back out, so this is going to be equal to $300 that you can see over here. And again, the max loss of this trade that you can experience on a rainy day is going to be the amount you paid to enter the trade, which in this case is $200. Now your max profit is achieved when the share price of the underlying stock falls equal to or below the strike price of your short leg. And you can see that here at this max profit. When it hits $35, that's when your max cap is reached. Max profit is calculated as if it were at expiration. You'd have to calculate it individually for each day to figure out what it would be on any given day that is not expiration day. That's a little more tricky. So people talk about max profit at expiration. So even if the stock price falls below the strike of your short put, you won't be at max profit if it's prior to expiration. You'll either have to pray to Lord Baby Jeebus that the stock price drops a little further, or wait until it gets to expiration day to reach your max profit. The further in the money you are, the less time that needs to pass before max profit is reached, assuming you haven't reached it already. You can reach max profit before expiration, you just have to be deeper in the money. Now it's worth noting, if you're in the profitable region, if the stock price starts going down as soon as you enter this trade, and if you're sitting in the profitable region, you've made some money because the stock price went down, but it starts trading sideways, each day that passes, you're going to be making more money, even though the stock is trading sideways. This is because the theta you're losing from the long put is going to be less than the theta you're gaining from your short put. Now this is exact opposite if you're in the loss region. If you enter this trade and the stock price starts going up and then trade sideways, each day that passes, the theta decay from your long put is going to be more than your short put. So it's worth noting that if you're in the profitable region, things are looking pretty bright for you. If you're in the loss area, things are going to be kind of shitty from day to day. However, it's going to be less shitty than if you had just bought a put outright. The theta decay from this that you experience if you're in the loss region will be significantly less than if you had just bought a put, where even if you're in the profitable region, you're experiencing negative theta decay. In other words, the theta decay of your long put is somewhat negated because of your short put. Now, a couple more calculations here. Your break-even point, I was going to write as BE, is going to be equal to your strike price of your long put minus net premium paid. Now you can see that here. I'm going to box that off. Ooh, that was bad. As you can see here, the strike price of your long put is $40 minus the net premium paid, which is $200, or written as 2.00. So now your break even is $38. And you can see that right here where that line crosses from making money to losing money, right where it's at $0 right here is $38 of the underlying stock price. Now I just want to mention, in case it's not clear, you're going to enter and exit this trade very similarly to as if you had just bought a normal put option. You're going to pay to enter the trade, and then you're going to receive money when you close the trade. And you're going to close both puts at the same time. So you're going to close your long put, and the put you sell, you're going to close at the exact same time. Okay, I got to be really quiet because my roommate's sleeping now. But if you want to increase the risk of this trade, and therefore increase the max profit, but also make the max loss worse as well, what you can do is increase the difference between the strike prices. That'll expose more risk. It'll cost more money to enter the trade, but you'll also have a higher max profit. And then likewise, if you want to reduce the risk, you can bring the strikes closer together. Of course, you always want to have the put you're buying ahead of the put you're selling. Thanks for watching, fellas. If you found this useful, definitely leave a like or subscribe if you're feeling generous. Every Tuesday and Thursday, I'm releasing a video in a series about option strategies. This video will be included in that series. Every Saturday, I'll be answering questions from you guys and making a video about that. So if you have any questions, go ahead and ask them away in the comments, or if you have certain strategies you would like to be covered in the future, also put those there. Thanks. Love you.